fast forward a couple of years. Let's say 2-3 years from now, you've been working as a full-time accountant all this time, and you have some money saved. So what do you do with that money? Do you buy or rent a fancy apartment in New York City? Do you get yourself a nice fancy car? Of course not. What do you do with that money? You invest it. The two most common types of investments are stocks and bonds. Stocks is where you become an owner of the company, and bonds is where you are lending money to another company or another type of organization. Companies do the same thing, publicly traded companies. Here we see Apple. Now, Apple's an outlier. They're known to have a lot of investments, but Apple has a lot of excess cash. It holds a lot of cash, but it also invests in the stocks and bonds of other publicly traded companies. And you see here highlighted on the assets section, marketable securities in the short term and marketable securities classified in as long-term assets. And if we look into the footnotes of the financial statements, we see a breakdown into what type of investments, what type of asset investments does this company have? Financial investments, of course. And we see that the greatest investment here is in corporate debt securities. In other words, investments in other companies' bonds, or we can say Apple is a lender. They give up cash to other companies, they buy their bonds, they receive interest revenue throughout the maturity, and then they receive repayment of principal at the maturity. And we see here that of the $183 billion of these investments, $87 billion come from debt investments. Some terminology, so two sides of the transaction. One side of the transaction is the borrower or the issue of bonds. When we say debt, generally we're talking about bonds. The bond issuer is the one who's getting the cash on day one. They issue a certificate, an IOU, and they get the cash. They pay interest over time, a steady stream of interest typically, and they pay the principal back at maturity. That principal is also known as the face value. The other side of the transaction is the lender, or the buyer of the bond, or the creditor, or the investor, or the holder. They all mean the person who now has an investment. They are going to earn the interest revenue over time, and they're going to receive their principal at maturity. Does it sound familiar? We covered this in Intermediate 2, and you don't need to write this down now. We'll get there. Bonds, we looked at them from the perspective of the borrower. We say that bonds are generally going to require the borrower to pay interest at a stated rate, also known as the coupon rate or the nominal rate. That rate is based on the bond's face value, also known as the maturity value or par value. Bonds are typically issued in increments of $1,000. It's an easy way for companies to make a whole lot of cash. One way is issue shares of stock, but that dilutes ownership. Another way is to issue $1,000 increments of borrowing bonds. And when this goes out to the public and each individual investor has $1,000 they're willing to give up in exchange for that interest, plus of course repayment of principal, you can sell a lot of bonds, you can raise a lot of cash. Interest is generally made semi-annually, and the stated rate sometimes differs from the market rate. The stated rate is what that bond certificate or the borrower promises to pay, but the market rate is what the actual interest rate is at any given point in time. On issue date, typically the market rate is equal to the stated rate. In our problems, they're not, but in the real world, they generally are. The thing is, once the bond has been issued, each moment that passes, market interest rates may change, causing the fair value or the price of the bonds to change. But anyway, we're going to assume sometimes that the stated rate on issue date does differ from the market rate. If the market rate is higher, the bond will sell at a discount because when you're looking to invest, well, do you want to get, let's say, a 5% stated rate on the bond when similar bonds are offering 6%? Of course not. More money is always better. Write that down. More money is always better. The market rate is lower than what this one particular bond is offering. Well, everyone wants that bond, so the price gets bid up and the bond will sell at a premium. Price of bond, of course, is equal to interest and principal. And just to briefly review, an example from Intermediate 2, we had Derek Jeter's coffee shop located inside Yankee Stadium. The company issues $100,000 face value, 5-year, 8% stated rate bond. It's issued at a discount, only gets $92,000 at issuance. That's because the market rate of similar bonds is higher at 10%. We don't need to write this out. We're going to be doing enough of our writing out as we proceed. But just to look back at what the entries looked like from the borrower's perspective. Well, the date that the bond is issued, the borrower receives the cash. This is the whole point of the bonds. They receive the cash at the price of the bond, $92,278. In the future, they owe $100,000, the face value of the bond, and that difference gets recorded to the account discount on bonds payable. You having some flashbacks from Intermediate 2? Good ones, I hope. As time passes, the borrower records interest expense. First interest payment date, principal of the bond, times the stated rate of the bond, times how much time has passed. Bonds typically pay interest semi-annually. So we have this cash payment in this example of $4,000, but that's not interest expense. Interest expense is the portion that's cash, plus it's also the amortization or the reduction of that discount. So in order to calculate the interest expense, we took the beginning carrying value of the bond, $92,278. We multiplied it by the market rate, also known as the effective rate or the yield of 10%, and then times half the year that has passed. The discount amortization, remember the discount carried a debit balance. We're reducing that discount by the amount of its amortization, the difference between interest expense and cash. At the end of each period, we looked at the ending carrying value of the bond. The discount got smaller, so our carrying value got larger. Now we're going to take a look at what happens when we have debt investments and we are on the other side of that journal entry. So let's start with some notes. Let's assume, or let's look at our examples for class. A company issues $700,000, 12%, 3-year semi-annual bonds for $666, $634. The market rate on the bonds or similar bonds is 14%. That's our starting point here. Okay, so part A is asking us, well, how do we get this 666, 634? How did we come up in this example with that price of the bond? So let's copy this data and go to Excel and see how did we get that price. So what we have here is the principal of the bond, $700,000. We have a maturity of 3 years. These are semi-annual bonds, and the stated rate is 12%. I'm going to say 12.12 annually, and I'm going to say the stated rate is half of that semi-annually. That's what we're going to need. Because of compounding, when we use the present value function, we need this semi-annual rate for the stated rate. And then the market rate is 14% annually. And these are semi-annually, so half of that every 6 months, the market is offering 7%. Okay, so the present value or the price of the bond is equal. We can use the present value function in Excel to determine what is the price of a bond. If the rate, now this first rate, we want this to be the market rate. What's that going rate out there? We want that to be 7%. The number of periods, I should have put one in here for the maturity, 3 times 2, because it's really 6 periods, 6 semi-annual periods. The payment is going to be equal to, we have to pay out negative 700,000 times the stated rate on a semi-annual basis, 6%. Okay, so 6% twice a year gets them that 12% over the entire year. The future value is going to be, we have to repay out 700,000, so negative for pay out 700,000. And here we get the price today is 666,634. All right, so we've completed our first item here, show how to get the price of the bond. B says record the entry for the purchase of the bond by the buyer. So let's start with our notes. We are looking at not the borrower's perspective, but the entry to purchase the bond. We get an asset. We're going to debit the account asset investments. Debit the account investment in bonds or bond investment or debt investments. Our textbook uses the account title investment in bonds. So debit investment in bonds for the full 700,000. That's what we're going to collect at maturity, or sorry, that's what we are going to, that's what we're going to collect at maturity. We are giving up cash to buy the bonds at the price of 666,634, and that difference between 700,000 and 666,634 works out to be 33,367. And this is recorded by the buyer in the account discount on bond investment or investment in bonds. Now remember, when we looked at this from the borrower's perspective, the discount carried a debit. Everything, and remember the bonds payable carried a credit. Now we're flipping it. We have an asset investment in bonds of 700,000 reduced by this discount, which now carries a credit balance. So let's write here that this discount in bonds has a credit balance. It is a contra asset that reduces the value of our asset investment in bonds. Okay, so at this point, the balance sheet reports the carrying value of the bonds at 666,634. Next, we're asked to record the purchase of this was the entry to purchase the bond on, let me just add the date here, on July 1st, 2024. The next entry is for the interest, the first interest receipt. On 12/31/24. Just move myself over here. All right, we are the investor, the holder. We're receiving the cash. So we're going to debit to increase cash. This is going to be at the bond's stated rate. So the principal of 700,000 multiplied by the stated rate on the bond, which is 12%, times 6 out of 12. This works out to be 42,000. I'm going to skip a line here. And then I'm going to need another debit. But first, I'm going to record the increase in interest revenue. So credit interest revenue. And we're not going to do the full 700,000. Remember, we take the beginning carrying value of that bond, which was investment in bond 700,000 minus the discount 33,367. The beginning carrying value is 666,634. Multiply it by the market rate, which was 14%, times 6 out of 12 for the semi-annual periods. Okay, so our revenue, remember when we did the beginning carrying value times the market rate, we called this is the use of the effective interest method. You don't need to know this, but that's what we're using. This is the effective interest method, as opposed to the straight line method. GAAP allows both, but says companies need to use the effective interest method if it's materially different from the results you would get from the straight line method. So in other words, use the effective interest method. This works out to be 46,664. All right, so our equation doesn't balance. We see here that we need a debit for the difference. The difference is 4,664, and this is going to be a decrease to this credit of discount on bonds, discount on bond investments. So to decrease the credit balance, I need a debit to the discount on bond investment account. Okay, so next we're asked at this point, what is the amortized cost of the bond investment? So amortized cost on 12/31. What gets reported on the balance sheet? We have the asset, investment in bonds, at 700,000 minus the balance in the discount account. Okay, what's our balance in the discount? It started off when we purchased the bonds. It started off as 33,367, and then we reduced it by 4,664. So our discount on December 31st is 28,703. This gives me my carrying value, or what we're going to be referring to as amortized cost. When we're using it for an investment in bonds, we're calling it amortized cost, 671,297. The balance sheet would report all of this. Probably it would just report investment in bonds, at amortized cost, 671,297. As we'll see, only if the bonds are classified as held to maturity, but let's not worry about that just yet. Okay, so let's go back to make sure that we answered all our questions here. Yep, done with example 1. Let's put in some notes. The first is that interest revenue on a bond investment is equal to the beginning amortized cost, or the beginning carrying value, either way, what we're looking at, and whether you're going to call it carrying value or amortized cost, we're going to call it amortized cost, is going to be the balance in the principal, the face value, the initial investment account, minus any discount, the balance in the discount, or the investment account plus any premium. In this example, we see that the market rate was greater than the stated rate, so the bonds were issued at a discount. But if the market rate was less than the stated rate, the bond would have been issued at a premium. Okay, so starting point, beginning amortized cost, multiply that by the market rate, sometimes known as the effective rate. And then for semi-annual bonds, multiply by 6 out of 12. 6 out of 12. If they're semi-annual interest payments. Okay, so the buyer of the investment, the holder, continues to amortize the bond. The discount or premium, each interest date. All right, so if you're holding the bond for 10 years, you're going to record this 20 times. Here's the thing though, market interest rates change over time. All right, when we said that the market rate of interest was 14%, we meant on that date that the bond was issued. So what if on December 31st, 2024, the day the financial statements are prepared for this company, in example 1, what if market rates are now, they were 14% on date of issuance, what if they're 15% now? Market rates go up, that causes the price, the fair value of these bonds, the price that the company could get, or the investor, the holder could get if they sold the bonds. If market rates went to 15%, the price of this bond would fall because it's offering even less than at the issue date. So the price of this bond would fall. The price of the bond, just write this down, the price or the present value of the bond is based on market interest rates. And we saw that it's based on the principal, the time to maturity, the stated rate, and the market rate. And is called, so the price or present value is also called the fair value. Fair value, the technical term of fair value is what amount could you get first if you were to sell your asset, the investment in bonds. If you were to sell it at any given point in time, what is a reasonable amount of cash you would expect to get in, as long as the market is a normal, orderly market. It's not some fire sale. There's no major collapse in the financial markets. So if you were to sell, you own this bond investment, you have it at an amortized cost of $671,297. If you were to sell it on December 31st, 2024, when let's say that the market interest rates were 15%, the price would fall, but you want to sell it because you're concerned interest rates are going to go even higher and the price is going to fall even lower. You would get, the amount of cash you would get is considered the fair value. Fair values changes because interest rates change. As time goes on, interest rates, they change. It's a market. So fair value changes every time the market interest rates change. Changes in fair value or changes in prices. So changes in fair values of bond investments that are held, meaning not sold. What do we do with that? What do we do with the fact? So if we know, if we have a building, the asset building, and the Zillow value, the Zestimate goes up on that building, or we get it appraised and it goes up, we know GAAP says don't record that. Just ignore the fact that it went up. Good for you, but you're not selling it, so don't do anything. But bond investments have these liquid markets typically. So what do we do with the fact that maybe the fair value's dropped dramatically? Do we want to give that information to the investors? Well, the changes in fair values of bond investments that are held, they're not sold. The changes in value are called, so just the changes in value, they're called unrealized holding gains or losses. To realize something is to turn it into cash, so unrealized means not sold. We're holding on to an asset and its value or fair value has changed. These are unrealized holding gains and losses. So the holder of the bond investment, they can sell it any time and they can realize that gain or loss. But what about when they're not holding onto it? What do we do? Do we report unrealized gains and losses on investments in bonds? That is the question. And the answer to that is, it depends.